Live. Yes, this is John Checky, co-founder of Checky Financial and co-author of Spend Time and Save Money. Coming to you live from Richardson, Texas, John Checky. We repeat ourselves a couple of times just to make sure it's being properly recorded. Question for the day. Do you understand your life insurance? Lots of folks over the years, especially when you were young and in college or starting out in life with children, buying a home, a car, etc., over time, were sold life insurance. And for many years, it served its purpose. In some cases, you built up some investments within it. Other cases, you were betting you're going to die young, and thank God you lost the bet. And you may have outgrown the need for it or the purpose that you originally bought it. Or, frankly, you never understood what the heck it was in the first, second, or third place. And the guy or gal that initially sold you that is long since out of the business or is too busy to return your calls. So, question of the day is, do you understand your life insurance? And if not, we have lots of information to pre-educate folks in terms of what it is you own. Does it properly serve you? Is this what you need at this time? Is it something that's going to help you with future planning needs for your family, for yourself, for your estate? And in some cases, eventually when you get to go finish up being alive here on earth and go to the next stage and step of life after death. So give us a call, Checky Financial. We would love to talk to you, but let's briefly go over some information in terms of the different types of life insurance. When I was a little kid, my father bought an endowment policy. Purpose of an endowment policy is like a tax-deferred savings account that may or may not earn competitive interest. It just depends upon what interest rates are doing. And the purpose of that was to accumulate way back when $1,000 by 1968. Now, one, 1968 was a long time ago. Two, $1,000 was a lot more money back then than it is now. And three, as a welder, he just made contributions on a regular basis to that policy. And by the time I was 21, he had, in fact, actually accumulated $1,000 in that policy. The policy had served its needs. By that time, I was 3 years through college, already married, I think, and actually didn't get married till 69. But at any rate, he combined that with other assets that he had over time. And after he died, my mother inherited enough assets where she was retired from 1977 until 2017 when she passed away at 95. Having been born in 1922. My mother also had another life insurance policy, which was one of those little debit policies where the insurance agent would come by once a month and literally collect loose change from my mom. It was a specific amount. It was called a debit insurance policy. But the biggest surprise that I got as a young kid in Hasbrook Heights, New Jersey, was one of our neighbors' dads, big guy, strong guy, literally was a grave digger. Back when graves were dug with picks and shovels in New Jersey, where I grew up. He passed away. And when he passed away, since his wife was a full-time mommy at home with the kids, we had a real curiosity about how that would work for them. And lucky for the grave digger and neighbor, he had some life insurance, which his wife used to go ahead and preserve their lifestyle, pay their mortgage on a regular basis, and get a fresh start in life. She now had become a young widow, probably no older than 30-something years of age. So the average age of a widow in the United States is a lot younger than you think. It's less than 60. It used to be 52. Thanks to the miracle known as COVID, it probably is drifting downward in certain cases, certain parts of the country. So one, we've covered debit life insurance. We just pay some coins periodically. Two, we've covered an endowment policy, which is like a savings account with a life insurance kicker And what do I mean by a life insurance kicker? Let's say you had an endowment policy and it was structured so that it had a death benefit of, we'll say, $10,000. And you built up cash over time. But if you died before you built up the cash that you were looking to build up, it would pay your survivors, the beneficiaries designated, or your estate, depending upon how you filled out the beneficiary form, the proceeds from that policy. Same is true with the debit policy. It, over time, had a life insurance value, meaning that if you died, someone, your beneficiary, would inherit the funds from that. So two very simple, old-fashioned types. Another type called whole life. Whole life pays interest over a period of time, and there are lots of people giving seminars on whole life entitled How to Be Your Own Banker. How you can put money away pre-tax, actually post-tax. Now, what does that mean? What does that even mean? Now, as a certified public accountant and a certified financial planner, the terms pre-tax and post-tax have meaning to me. However, to you, a regular person, unless you're in that business, tax preparation or tax planning, would say, what the heck are you talking about? Let's put a halo on that right over the light behind me. Pre-tax is like your 401k or your IRA or your pre-tax account as a school teacher, which is commonly called a tax shelter annuity or a tax shelter custodial account, where you get a tax deduction. For instance, let's say you make $10,000 a month. You put away, just for a fun figure, $1,000 a month in a pre-tax account. Your gross income is reduced from $10,000 to $9,000. The difference between the $10,000 that you made and the $1,000 that you put away pre-tax. But let's say you opened up a post-tax savings account, just a non-qualified or a Roth, which we'll explain later. And you saved that $1,000 or invested the $1,000. You would not get a tax deduction, but it would grow over time, God willing, if markets grow or you're earning interest. But going over the whole life policy, it normally pays dividends, it pays some interest over time, it has a death benefit. It's intended to own for a very long period of time. It should build up some cash value if it's properly funded and structured. And over time, you can take money out of it and use it for various other purposes, whether it's educating children or buying a car or buying another house, whatever it is you'd like to do with the proceeds before your demise or death. A third type of argument was back, probably about 35 or 6 years ago. A fella came out talking about buy term life insurance and invest the difference. I'm not going to tell you the guy's name. He was a football coach and had a ton of people following him. And there's a major group that still peddles that idea. Term life insurance is basically you get examined, get approved, and get a policy for a period of time, which stated that it will pay your beneficiaries a death benefit if the policy is still in place. There was no misrepresentation when you first applied for it. And third, is in good order, and they can locate the beneficiaries. Has no cash value, no investment value particularly, and when you die, it pays a benefit. Very few people ever collect the benefit associated with term life insurance. And you can ask, why is that? When you're young, it's a wonderful bet. You bet you're going to die young. It does happen, folks. Make no mistake about it. Sadly, though, when you live a long time, eventually, one, they won't insure you anymore, or two, it gets so tragically expensive to have the term life insurance that you decide, heck, I'm not going to bother with it. So you let it lapse. So you basically wasted money over a long period of time betting that you were going to die young. However, if that's all you can afford, it can serve a wonderful purpose, especially for young families, to go ahead and make sure if mom or dad dies and they're the one that's insured, the survivor, along with the children, at least have some additional funding. The expression "and invest the difference" came about where there was a premise or an argument stating that they didn't like the people that were talking about whole life insurance and suggested that you could make more money long term if you bought term life insurance and invested the difference. Depending upon the investments, depending upon your tax bracket, depending upon taxation systems, that may or may not have validity. Personally, I was happy when the insurance industry invented something called universal life. And universal life took the buy term and invest the difference and put it in one package called universal life. And you can build up cash over time, still have a death benefit. Maybe you're going to have the cash piled on top of the death benefit, which is a fabulous technique for folks to accumulate wealth, put in lots of money. In fact, it was so popular in the early 80s that the United States government, Congress, passed a law saying you can only put so much money in it, because smart folks that understand how tax deferral and tax-free on the other end works put zillions of dollars in that particular investment. So with that in mind, that's the difference between buy term and invest the difference, called universal life. We can do both in the same contract. Another type of universal life is called variable universal life, where it has investment accounts within it that you can choose. Anything from mutual funds to stocks, it just depends upon what the life insurance company put in there. That's called variable universal life. Also has a death benefit and some accumulation over time. A third type is equity indexed universal life, which again has indices, whether it's the Dow Jones Industrial, or the S&P 500, or the NASDAQ, which is the National Association of Security Dealers Automated Quotron System. I just love remembering that, excuse me. So those are about 6 different types of life insurance. And over time, we have delivered death claims to folks. Over time, we've helped folks get money out of life insurance policies to go ahead and help fund college education, buying a car, paying off a house, and whatever the heck it is folks want to do. And based on tax law, there's some great tax advantages associated with that. This is John Checky telling you just a little bit about life insurance and the different types of life insurance. I hope you enjoyed this video. We're at 972-437-4089. Checky Financial. There's lots of information on our website, lots of pre-recorded messages there too, explaining the concepts we just mentioned to you. Y'all have fun and be well. Look forward to seeing you sooner rather than later, and stay strong and healthy out there.